Hey, folks, so it's my pleasure to bring back Amar Shah from ClientFirstCapital.com. It was actually ClientFirstCap.com. And we did a podcast with Amar about a month or so ago, Amar?
About that, yeah.
And Amar has sprung for Zoom, and he's paying the big bucks so we can have this video recording because I think it's pretty interesting because we're going to talk about two things today. One, we want to talk about Secure Act because it is a big deal. It really is. It looks like, I mean, it's already passed the House, right, Amar? And I would be stunned if that didn't make its way to Trump's desk for sure.
Yeah, well, it's hung up in the Senate. I mean, but it's there. It's there. It's on its way.
And I think what only a couple of people have, I think Ted Cruz is expressing, at least he was last week, in terms of something like with homeschooling or something like that. But other than that, pretty much else is almost unanimous, right?
Yeah, in the House it was 417-3.
Yeah.
So it's pretty clear that it's going that direction. Yeah,
and that's going to, and of course, anything that goes through committee. So the House passes, the Senate passes, then it goes to committee, and then they got to the sausage making before it ends up on Trump's desk. But it's in my opinion, both. I think I speak on behalf of Amar. We both think it's going to get done. And there's some issues we got to contend with. We'll talk about that here today. Secondly, I still want to look at bonds. So, I don't manage money, folks, and I'll just show you the 10-year treasury as I always do. The 10-year right there. So if you look at the TNX, you can see the 10-year treasury is at 2.05. So there's no there. But the more I was looking at Wellington Fund and Wellesley Fund, the more I have come to the conclusion that bonds do get you that cushion. There's just no other way around that. I mean, stocks, I like stocks without question. You should be having stocks. The issue when it comes to bonds is that just historically they have given you that cushion against a catastrophe. And I think it's easy to forget that the S&P 500 was down 55% from October 2007 to March 9th of 2009. And if you had the Wellington, you're only down 37% that time. And if you had the Wellesley, you're only down 15%. And the reason that is because the bonds. There's just no other way around that. So we're going to talk about bonds too, because as much as I like my theoretical, there are a lot of people who are interested in bonds. So we'll talk about that. So welcome back, Mark. Appreciate you having on the video and the podcast, man.
Yeah, it's awesome. I may get used to this.
Yeah, man, it's always good to put a face to the name for sure. I'm sure the good folks on YouTube land is like, who is this crazy guy, Amar? I'm glad to see what he looks like for sure.
Yeah.
So, go ahead.
No, go ahead.
Hey, so what's your what's your take on Secure Act? What do people need to be worried about?
So I think with all things we need to evolve, right? When Social Security first started, people would collect for a year and then pass away, right? And then when they extended the age from 65 and they started to push it up to 66 and a half, 67, and so forth, they did it in a way where people were notified 10 years in advance, right? Which is really good for individuals to plan, and then they know what's happening. And I think that evolution should continue. So, 70 and a half to 72, I think it's good. You're not forcing people to take money out. As an advisor, we do financial planning, right? And we oftentimes say, all right, this is how much income you need. And it's coming from your R&D, Social Security, from your income earnings from your investments. Sometimes you have more than that, and we say we're going to reinvest it, but we never really do sometimes because we have the income coming in, life happens, we want to spend it.
Yep.
And so delaying that mandatory distribution, and actually the other thing that they're doing is they're spreading it over more years.
Oh.
Right.
So they have changed. So they have changed the tables, or they're thinking about it?
Tables automatically adjust with age, right? Because the IRS sets the tables.
Right.
But I assume, when you have these RMDs, they start off at 3.6% or so.
Right.
They start to go up, and then as you turn 80, they start to go up faster.
Right.
80, they start to go up really fast. And one of the things that I assume by delaying it to 72, that the IRS will look at the tables and say, hey, we're living longer. We need to do that longer because, oftentimes you find somebody that's in their late 80s or 90s, they're taking a good chunk of their IRA out.
Is that I was wondering about that. So that's not necessarily part of the legislation yet in terms of changing the tables. It only makes sense. I was wondering about that, but okay.
So this is me making some assumptions that if the Secure Act goes through and we're to change the required minimum distribution start age to 72, we're gonna have to redo the tables.
Yeah. Okay.
Yeah.
And I hope they do that. I would be. I mean, I just can't imagine the IRS doesn't redo the tables. I just can't. But
I mean,
weirder things have happened.
Yeah, and so spreading the distribution over more years, and I say this all the time, is IRAs are great while you're working because you got this deduction, but it's a bomb when you're in retirement.
Yeah.
And so spreading that distribution over the most amount of years possible is the key to success in your tax consequences. And I think that, if they change the table and they spread it, I think it's good. Not like there's also downsides is like they're trying to limit the beneficiary distributions over 10 years.
Yeah, that's a big deal.
That, right? It's like, they, I guess that, part of me feels like, Congress is making sure people have job security. But so check this out. So you can go to your spouse and there's no issues. And, well, there is an issue. Most retirees are now doing the standard deduction. Yeah. Because it's so high. And if you do the standard deduction and one spouse passes away, you lost one of the spouse's deduction. If that spouse is over 65, you lost another $1,300 or so because of that. And so, and the RMD is probably right about the same amount.
It'd be close enough, absolutely. And it's So
now you lose the standard deduction. Now after the second year, you're filing as a single individual, so you have a higher tax table. And you're taking more taxes out of the IRA there. But the biggest change is that husband, wife, and now you have kids.
Yep.
Kids can't stretch it over their life expectancy.
That's crazy.
The life expectancy table. And I think that's just going to. So, like, you think mom and dad, right? Mom and dad, in their 80s or so, right? If the event to happen, kids could be, in their 60s.
50s even. Yeah.
50s, 60s. I mean,
and they're prime working years, Amar.
Prime working years, you're top of tax tables, right? And so now you take, let's just say a couple that they may have $1 million IRA and they have let's say 2 kids, right? $500,000 distribution over 10 years. Let's just call it $55,000 a year because you're going to have some growth in there at your highest tax tables. And so, like, on a federal side, plus some states like California has state tax on top of it.
Yeah, it's going to kill you. I mean, think about that. You're in your highest earning. You're 55 years old, making more money than you ever thought you're making. Mom dies after she inherited the IRA from dad, and she's got that $1 million leaving it to you and sis. That's $500,000 each. And what is it 10 years or 5 years or something like that?
So they tried. There was this rule where if it went to a trust, it would have to be distributed in 5 years. They went that, and they're just saying 10 years. And there's a single life expectancy table, and they're getting rid of, so they're just saying 10 years. Right?
So you got 10 years to exhaust the whole thing.
Yeah.
And so now you're like, man, not only am I in my highest, even worse, let's say you're 65 years old and you inherit that. Yeah. Medicare. What does that do to your Medicare premium? Right. I mean, it's just, it's a wonderful, if you're looking to increase taxes, it's smart as hell. You know what I'm saying? Because you get like, we're going to hammer these people. Yeah. Crazy.
I mean, this is why I'm saying, like, this, for most people out there, right, they're going to have to evaluate this.
Yes, absolutely, man.
Work with their financial advisors or CPAs or whatever to say, like, hey, I want to chart out my tax consequence, based off the tax code today, because nobody knows what happens in the future. But based off of today, what would happen to my taxes if this event happened or that event happened? And that really, revolves around death, right? You know,
It's,
spouse passes
it's
away.
crazy.
What
Because
happens if I survive the spouse in terms of taxes? As a family unit, what happens?
Exactly, as a family unit. Yep.
Yeah, as you know, what happens to my children, right? And so a lot of the conversations could be around, you know, one of the things that you and I both love is Roth IRAs, right?
Absolutely.
You know, mom and dad, you know, they may just have Social Security and RMD, whereas kids are still working. That could be in a lower tax bracket. Because they're in a lower tax bracket, why not take a little bit more out now? Either do a Roth conversion, or if you need the money for investments or other purposes, you can get a step up in cost basis. So that could be something that people look at. And, you know, comparing the rates of the kids and I mean, so there's math involved.
Yeah, nice.
It's not as simple as like, you should do this. There's
No.
You need
Actually, it's funny. Amar, I had someone on my YouTube channel on a live stream I did about 2 weeks ago. I can't remember if it was a woman or man, but they said, "Hey, this is great. It's Secure Act. That means I don't have to take RMDs. I don't have to worry about Roth conversions because I can push my RMDs." I was sitting there thinking that's exactly the wrong answer. I mean, that doesn't mean they should do Roth conversions, but this
you have time now. You built in more time. You should,
exactly.
And the other thing.
Exactly.
It allows part-time employees to continue to contribute to 401k.
Oh.
And this is something that, I mean, they're still trying to flush it out, right? But
right.
The earlier you save and create habits of savings, right? So if you're in college and you're a part-time employee, now you have access to a 401k.
Right.
Start saving more. And I think that's important that people start saving for themselves. I mean,
yeah, the whole thing about the 401k, I just, you know, I read someplace like this is the most, you know, compensating thing since George Bush signed the Pension Protection Act because it allows more people to save. And I think that what these people are missing is that a lot of these young people don't have the cash flow to save. You see what I'm saying? It's like, this is great. You're allowing more savings opportunity, but from where's the money going to come from? I don't find that the issue. I find that the issue on this is the ability to push back RMDs. And the big one, this is what I think is a net negative, actually, is where the big one is that, like we just talked about, the non-spouse beneficiary has to exhaust the account within 5 or 10 years, whatever, I guess 10 years. And
10 years.
That bothers me because I'm sitting there thinking, what I mean, look, you could see this coming. I mean, when they passed that non-spouse beneficiaries don't have creditor protection on IRAs, that was a unanimous Supreme Court decision in 2014. It was only a matter of time for Congress said, "Hey, let's start tapping in these assets for taxes." But it is the law. I mean, it was not the law yet, but it will be. And so we can not argue, but you get ticked off as much as we want, but this is what we're dealing with, and we need to be proactive. And I have a sneaky suspicion tomorrow a lot of people are going to take the exact opposite scenario. So
yeah, I mean, there's always change, right? Yeah. And it's always easier to do nothing.
Exactly, especially when you got 2 more years, you don't have to do anything. 2 more years, I don't need to take my required distributions. Great.
Yeah.
It's funny you said about RMDs too, because what I found is actually, a guy, Richard Thaler won the Nobel Prize on this on mental accounting. And when you said, when people take an RMD, they don't have to spend it, but a lot of times they will because that's like extra income they weren't expecting. And they're like, man, income is easier to spend than capital. So a lot of that RMD will be spent, but hopefully they'll put it into an account that can grow, like you're talking about for sure, for a step-up basis.
Yeah. So I mean, there's some. We got to see what the final bill.
Yeah, that's at the end of the day. It's all.
We can talk about this, but it's not what it's at. We have to wait until see what the Senate does. Yeah.
What I'd suggest to anyone watching, listening, whatever, is that if you're not, if this change comes and you're watching this, most likely you have assets in tax-deferred accounts, and you really need to get in front of this. However, by hook or by crook, talk to Amar, talk to your guy at Fidelity, talk to the guy at the church. I don't care. Talk to me. But you've got to get in front of this because this really can be beneficial if you're not required to take RMDs for a few years. But it can be it could be a pretty significant tax consequence to your loved ones downstream. And like Amar was saying too, just because you can leave it to your spouse and he or she doesn't have to take it exhausted in a certain amount of years, that does not mean the tax it won't be there. That's why we call it the widow's tax trap.
Yeah, I mean, and part of that, when we're talking about a family unit, right? Like, like kids, we said were peak earning years, and we said, let's just say 32% federal. Right?
Yeah.
Let's say they're really successful in their careers. And then you say, like California, they would pay another 7.5% to 9% on top of that, right? So 40% of your IRA, think about it, is going straight to taxes if it's a non-spousal beneficiary.
40%. It's like,
right? And then
did you say that? Go ahead.
Mom and dad could be in a lower tax bracket, you know, if they just have Social Security, IRA, or pensions or whatever. And so there's some math involved. It's not, you have to figure out where the even ground is, because a lot of people will say, like, all right, if we take these distributions, but I'm paying the taxes on them.
Right.
I don't want to pay the taxes up front. Let the kids deal with it.
Right.
So there's some values involved as well, like, you know, how much family money, how much you want to enjoy versus, you know, how much you're going to leave as legacy. And so it could be that you just partition your IRAs or 401ks into two parts.
Yeah.
So this is what we need to live off of. This eventually will go to the kids. Well, I don't want to give them a taxable asset. I want to give them a tax-free asset.
Yep.
Just put this amount into a Roth IRA over time, you know.
Or even if you have other assets, maybe start doing the QCDs, a qualified charitable distribution, and move it to, because like you had mentioned before, very, very few retirees are getting a itemizing anymore. You know what I'm saying? So because you're not itemizing, well, if you know you have an IRA over here, I was talking to a guy the other day, nice guy up in New Mexico, and we're talking, he wants to leave some to his church. You have a capital campaign at his church, and we're talking about the different scenarios on how to maximize his wealth and maximize the church's the donation. And this, long story short, just kind of going back to what you're saying, it's all planning. It's all, you got to look at the big picture.
Yeah. And you know, it's kind of funny. I mean, what I'm finding, and you can correct me if you find this differently, and I talk to estate planners and I talk to tax people, PAs, and for tax people, now that more people are doing a standard deduction, it's hard to create value as a tax professional. Say, hey, we should do, because the standard deduction is so high. And the same thing with estate planning. You know, people that did very creative estate planning. Well, how many people have over 22 million?
Exactly.
Yeah, and so that roadblocks for those people are not there. So I really think the right person is your financial advisor. I mean, they got the pulse on your investments, and then they got the pulse on, I mean, it's the person you're talking to most frequently, right?
Absolutely. I mean, hopefully you're not talking to estate planning every year. I mean, why would I don't know why you would need to be. Your CPA, sure, but
and hopefully family dynamics are not that volatile that you're talking to your estate planner that frequently, right?
I'm changing my will again. I'm getting Joni off and I'm putting Barbara on. It's like, oh, next year doing the same thing. That's good stuff, Amar.
Here real quick, and let's do a little bit of investments, because I think that is kind of cool too.
Oh, absolutely. Well, that's what I want to bring up. Going back to, I do get a lot of questions on the bonds, and like I said, I don't manage accounts, I don't manage bonds, but I know you are. You're an engineer by trade, man. So you look at all the stuff behind the scenes, and let's just see what we got going on out there in the bond market, if you will, and then we can talk about what you're doing with some folks.
This is just on Fidelity.com. I just went under rates. And
make it bigger a little bit, would you, Amar? It's I don't know, it's kind of small on my end.
Yeah, I'm gonna make it bigger for you here.
Okay, there you go. There you go. Good. Yep.
I just wanted to show this full page. So.
Oh, okay, gotcha. Right on. And this comes out every day, just on Fidelity.com.
Fidelity.com. Go investments, daily rate sheet under capital market. This is from yesterday.
Okay.
But I mean, like, have you ever seen rates this low?
That's what I'm saying. It's freaking crazy. And remember, they raised last. See, this whole thing, Mom. Remember, the Fed? They raised what, 4 times last year or something like that?
Yeah.
I mean,
and so let's just say, if we just take a look at one thing here. we look at U.S. Treasuries. Now, I don't know if this thing is going to work exactly right. So just give me a second.
Yeah, man. Well, I'm going to see if I can't pull this up myself while you're doing that.
So here's the U.S. Treasury right here. The 3-month is 2.02 as of yesterday.
That's crazy.
2.03, so that's pretty much flat. It takes 10 years till we get back to that same number.
That's correct. Look at that. 2.02 for 3 months and 2.02 for 10 years.
Out of my mind. And everything in between is either flat or slightly negative, you know? So like in my mind, I'd say it's flat roughly. And then it goes slightly negative and comes back up.
Well, look at the 30-year. You could lock up your money for 30 years, get 2.57.
Yeah. So fixed income. The reason why I wanted to show this is essentially fixed income is not like just buying an index fund and forgetting about it. You know, there's a lot more involved with like individual issues, where interest rates are. How long do you buy the bond? What is the credit worthiness of the bond, you know, that you're buying? And so, yeah, I wanted to share that, and I'm just gonna.
Hey, what's the tell the folks? You see the corporate BAA and triple B. What does that mean exactly? Tell folks what that means, Amar.
Yeah, I mean, these are the rating agencies, and they put, you know, their ratings on the different bonds that are out there. And I give an example as how likely you're going to be paid back, right?
Yeah.
So somebody that has really good credit quality will most likely pay you back, gets higher ratings, but gets lower interest rate because you know you're going to get paid back. There's less risk. Somebody that has bad credit rating, you're going to charge them a higher interest rate because there's some likelihood that you're not going to get paid back. And I can find a rate sheet, and we can go through some bonds. I mean, like you'll find like Home Depot and all the big companies. They're all ranked, you know, with their credit worthiness.
Is triple B, is that investment grade or lower than a junk bond? I can't remember, to be honest with you.
Yeah, so A is junk bonds.
Okay.
Yeah, so we want to. Triple B is like the edge, right?
Okay.
We want to stay above the edge, right?
Okay.
Investment grade bonds. I mean, it depends. If you want junk bonds because you're looking for yield, then
Right.
that's the place you're going to play in.
Yeah, but even there, you got a junk bond. You're locking up your money for 30 years. You're only getting 413 basis points for a lower than investment grade bond. That's not. I don't know, man. That's not that attractive to me. Hey, Paul, I'd be curious to see what a rate. Let's look at some bonds. I have. It's been a long time since I've looked at individual bonds. So yeah, it'd be cool to see like Home Depot. Pull something like that up.
Maybe I can pull up a rate sheet or the bond offerings. But for now, what I wanted to show you was, let's see.
Oh, there you go. Yep, daily rate sheet. There you go, man. Sweet. There you go. So anyone has access to this. I didn't know that. That's kind of cool.
Yeah.
And you have to bookmark this page, Amar.
There you go. Let's see. I'm trying to share my screen to another page here. And
There you go. Oh, sweet. Yeah.
Can you see this?
Yep. I like it.
So I went out and I compared a couple, bonds versus bond funds versus buying individual bonds. And one thing that we could do here is I'm going to show you where I got some of this data. So, just I use Google Chrome, but just go online, go in the search, type in a ticker symbol, and you can see here's the expense ratio. Here's the percent that's in each credit quality, duration, maturity. So anyways, I got all this data and I put it into this. Can you see my screen where it says portfolio key statistics?
I see. It's still showing the Vanguard page, portfolio composition.
How about there?
There you go. Here you go. Yep.
Yeah, there we go. So, I mean, I just took that same data and I put it here, right? And so the value of having individual bonds is you get to control all these different levers, right, by what you put in there, right? And so, you know, obviously, if somebody's managing individual bonds, yeah, maybe they do some credit sales. I'm not going to do it. You know,
I don't even know what a credit sale is. What is that?
so if somebody gets downgraded, right, then it would force a sell in the portfolio. So keep in mind, and I'm just using Vanguard here as an example. I'm not recommending or referring.
Right, understood.
These guys, they have a prospectus, and in that prospectus, they're forced by their mandate to sell if a credit quality drops below a certain amount.
Ooh.
And so these is the percentage of credit sales that they've had, right? So they may have a good bond a good company that has some type of event that happens that downgrades their credit, and they're forced to sell that bond.
I mean, so they've sold, the intermediate bond fund has sold 26% has been sold because of downgrades?
Yeah, so it could be downgrades, it could be upgrades. I mean, they could make
Whoa.
you find an equivalent bond, like their credit worthiness of equivalency, and they can just move from one bond to another bond.
Okay, I got you.
Stuff tied into this number. I wouldn't focus here.
No, but still, they've moved a lot. They moved around a lot because of credit rating changes, is what that says.
Yeah, and so there's turnover. What this
Exactly.
there is turnover. Yeah. And turnover, if you're in a taxable account,
That's
taxes, right?
even though it's a municipal bond, it's still paying tax on the turnover. Absolutely.
Yeah, it's kind of funny that like some people think since you have municipal bonds that there's no taxes, but you can still have a capital gain.
Absolutely.
And it could have a capital loss. I mean, coming back here, so I wanted to match the duration. So, you know, the average duration, we'll just call it between 5 and, 5 years, 5.5 years. And, yeah. I don't know, Josh, my mouse keeps disappearing. Oh, there it is. All right. So the average coupon, right? 4.5.
Just in case you're hearing me. Oh, all right, you're back, Amar.
Can you hear me?
Yeah, I can hear you.
Yeah. So I was just saying the average coupon's about 4.5.
Yeah.
They're pretty even across the board. Yield to maturity, right? Now, bond funds don't have an actual yield to maturity. They just, because you have to keep reinvesting, right?
Right, exactly.
So they do this calculation, but it's actually yield to market. And so, that's about the same for these two, California and intermediate tax fund. But if you buy individual bonds, you can structure it where you could earn almost, 30 basis points more.
It's more than just 30 basis points. I mean, that's literally, in that case, you're running the funds as 47 basis points more than 200 basis. That's a 25% increase. 47 basis points above a 200 basis point is almost 25% higher. You see what I'm saying?
Right. But like you gotta see there would be like my fee, right? There's no transaction cost here, but like I, as an advisor, because I'm taking the time to look and research these bonds, I charge a fee as well.
Yeah. Right. Well, understood. No, yeah, you're getting paid too. I get that. But when you buy the bonds, they're, you're buying them at par, or not at par, but you're buying them without, you're already paying the fee for the bond when they buy them, right? Because they're being marked up or something.
There's no like markup or like built-in spread.
Right.
That goes to, yeah.
So I mean, that's what I'm saying. So a client who uses you, they're paying through the markup or the spread of when you buy the bonds for that client, right?
No, I'm charging a fee.
Okay. Gotcha. Okay, gotcha.
Because
so
I'm a fee-only guy. But,
okay.
You could go to a broker, right, and say, hey, I want to pay the commission.
Right.
And I just want to buy individual bonds, right?
But you're not, there's no commission when you're doing it. So what we're seeing here is.
I don't charge commissions.
Gotcha. Right on.
I want to be fully transparent, and I just want to say, hey, this is the fee to have me.
Yep.
And, and that's it. I mean, I don't get kickbacks. I don't get shared revenue, no commissions, nothing else. So, but here's what look, the thing that I'm trying to illustrate here is that if you look at the credit quality,
Yeah.
we have more in double A's than the Vanguard fund.
Oh.
Right. We have a higher yield to worst. So like worst case scenario, you're going to make more than the Vanguard fund.
That's crazy, man.
If everything goes well, you have a higher overall yield, right? So let's not look at the difference. Let's just look in absolute. You have a better yield, better worst case scenario, and you have better credit quality. That's why you need to have individual bonds.
But look, the Vanguard Intermediate Fund only has 50% in double A?
Yeah, I mean, let's look it up. VWIUX.
Yeah, I'm looking at it right now. Exactly. I was like, dude, that's crazy, man. That's a whole lot more risky than I bet a lot of people recognize. If it's only got 50% of double A, you see what I'm saying?
Yeah.
I'm trying to find they do have a 15% turnover in this fund too, Amar, just FYI. So you're going to have some capital gains. Well, not with Vanguard because their capital gain. Well, I don't know about the bond funds. I do know the stock funds. I just did a video yesterday how Vanguard and Eaton Vance, of all places, they have some kind of patent on their mutual funds where they don't have to pay out the capital gains like every other fund company out there. Isn't that interesting?
Yeah. So I just went to Google and put VW up here, and you get the VWIUX. Here's a Vanguard Intermediate Term Tax Exempt Fund, right? You scroll down.
I'm just trying to see the
right. So this is the border, right? You want to be north of triple B and north, right? Which this fund does, right? But only 50% of it's in double A's. 20%.
Okay.
I mean, 20% in triple A is pretty good too. So.
Yeah. Well, there you go. Okay. So
very secure type investments.
Yeah, they're about 70% in AAA and AA. I mean, that's nothing wrong with that, but it still is a lot. I mean, 30% is below AA. That's a fact right there. You see what I'm saying? That's interesting. That's definitely not that's definitely riskier than you would think, I would have thought.
Yeah, yeah. I'm
looking up, I just want to look up Fidelity Intermediate Bond, Municipal Bond Fund. I do find it actually kind of frustrating how people think that there's no taxes in municipal bonds. Well, there is taxes on the mutual fund side because of the turnover. And if just because it's a tax exempt, it's only tax exempt on the income. It's not tax exempt on the price per share. And I do think a lot of people overlook that, actually. That's pretty interesting. I've always been a huge fan of it. Well, you know me, when we worked at USAA, I loved individual bonds more than mutual funds. You know, USAA has some good mutual funds, but the individual bonds are the way to go. You know exactly what you're getting. As long as the company doesn't go bankrupt, in this case, as long as the issuer, the municipality, the bridge, the hospital, the school district, as long as that doesn't go bankrupt, it's not Jefferson County, Alabama, they're likely to get your money back, plus tax-exempt interest as well. It's a big deal.
And when interest rates are so low, taxes play a bigger percentage role.
Right?
So it is, I think, a place where individuals can get more traction with their money is having those individual bonds.
No, I agree with that. One of the things I do also like about individual bonds is you can actually scour the market for discount bonds or premium bonds. You can look either way as opposed to just. The thing with the mutual funds, you're hiring a guy or a lady to do that for you. That's fine. And Vanguard's got great bond. Amar and I are not saying anything negative on Vanguard. But the drawback is you are only getting proportional portion of the assets relative to the shares itself. And I hate to say, you're $100,000 in the Vanguard tax-exempt municipal California bond. It ain't much relative to, they probably got $40 billion in there. So you get a tiny little proportion.
Right, yeah. And so, what would be the advantages of the Vanguard fund or any mutual fund, right? Is that they're buying thousands of
Yeah. Right.
So your spread very in like all these different. So if one bond did default, right, you're not taking it in the you're not getting hit.
No.
And so there is something to say that there's diversity in having thousands of bonds. So you have to weigh the pros and cons. What's important to you.
When I worked at Vanguard, this is back in the late '90s, I remember talking about their high yield, the junk bond fund. And Vanguard, they had a study that said if 5% of the funds of the bonds in the high yield fund went kaput, it'd knock off like 3 cents on the NAV because that's how many bonds they had. We have so many bonds that at 5% all in one time would go kaput, bankrupt. It would literally be just like a nick on your ear. You would never even notice it. I don't know if that's still the same case, but that's the benefit of diversification. Of course, the negatives is what we just talked about.
Yeah.
All right, man. Anything else jump out at you of financial planning, investment stuff that the world needs to hear? Because the world is watching, Amar. The world is watching as we speak. Yeah. President Trump is out there sitting there thinking.
Gosh, I mean, you're kind of motivating me to get out there more. I'm not much of a person to be on YouTube, but yeah, no, I appreciate. And I think this is good. I mean, I don't have anything else to add.
Well, we'll try to do this once a month, and folks, if whoever's watching, if you have a specific question that you want Amar and I to address, we're going to make this a monthly thing. Hell, maybe we can even do it live at some point, Amar. If you want to ask questions, it'd probably be better to do it live on once a month. I think it'd be fun. Got to figure out how to do it, but we'll figure it out. And then, ask questions, fire away, and anything that comes to mind that you want. So just remember, if I may, Amar is the investment. I mean, he's a financial planner. He's a CFA and a CFP, so I don't want to discount that. His nose is a lot more into the investments going on than I am. That's the fact. So when it comes to specifics, I'm a generalist, where Amar is a specialist for sure. Now, that does not take away from his credence of the financial planner. He is a good financial planner, too. I don't want to discount that. But if you have more specific investment-related questions, Amar would be a good person to talk to because he has his nose in that a lot more than I do. So, all right, Amar, I appreciate it, man. Don't forget to send me your disclosure that I got to put on here. We'll hang tight after we're done here, and then we'll catch up.